Welcome to our deep dive into investment strategies. Today, we're exploring two distinct paths for your portfolio, the classic buy and hold approach versus a more active annual profit-taking strategy. Using NVIDIA and NVIDIA stock as a real-world example, we'll uncover how these choices dramatically alter the outcome of a $100,000 investment over 5 years, from 2020 to the end of 2025. The scenario. Let's set the stage. Our starting point is a $100,000 investment made on January 2nd, 2020, entirely placed in NVIDIA, a leading high-growth tech stock. For clarity, we're using illustrative tax rates, 15% for long-term capital gains applied to investments held over a year, and a 30% short-term rate for gains on assets held for a year or less. Please remember, actual tax rates can vary, and this analysis is for illustrative purposes. The investment journey. Now, let's visualize the investment journey. Our first chart, the investment journey, vividly tracks the after-tax capital growth for both strategies. Notice the two distinct lines. The purple line represents annual profit-taking, and the vibrant orange line shows buy and hold. You can clearly see the buy and hold strategy, orange, maintaining a more powerful and steady upward trajectory, while annual profit-taking, purple, experiences more volatility and a less aggressive climb, particularly after tax implications. The final verdict. The culmination of these strategies is truly striking. Looking at the final verdict, after tax capital in 2025, the difference is undeniable. With annual profit-taking, your initial $100,000 grows to approximately $1,157,315, resulting in an impressive 1,057% ROI. However, the buy and hold strategy delivers a significantly larger sum, reaching about $2,377,597, yielding an astonishing 2,278% ROI. The bar chart, Final Capital Comparison, emphasizes this stark contrast, showing buy and hold more than doubling the final capital of the annual profit-taking approach. Why the drastic difference? So, why such a drastic difference? It boils down to two core principles: the power of compounding and the burden of taxes. Firstly, the power of compounding. Buy and hold allows every dollar of profit to remain invested and generate further returns. This uninterrupted compounding effect creates exponential growth over time. In contrast, annual profit-taking resets this engine yearly, forcing you to rebuild momentum from a smaller taxed capital base. Secondly, the burden of taxes. Frequent selling in the annual profit-taking strategy triggers higher short-term capital gains taxes each year. This constant tax drag eats away at your capital. Buy and hold, on the other hand, defers all taxes until the final sale, benefiting from the lower long-term capital gains rate, ensuring more of your money stays invested and continues to grow. Conclusion and disclaimer. In summary, for a high-growth asset like NVIDIA's over a period of strong market performance, the buy and hold strategy proved to be overwhelmingly superior, primarily due to the potent combination of compounding and tax efficiency. While the allure of gaining profit at the end of the year might seem appealing, the tax implications and the loss of compounding can severely limit overall returns. Finally, a quick disclaimer: this analysis is illustrative and based on historical data and future projections. Past performance is not indicative of future results. We strongly recommend consulting with a financial advisor before making any investment decisions. Thank you.